or defense. So, and now it is trading at 21 times next year earnings. It is not so expensive.
Okay.
Management outlook is very, very positive. So, or for example, say in power T&D sector, you know, something like KEC, you know, where...
Yeah, not everybody is coming out with good numbers.
Yeah, so, and KEC is again a company where every quarter you are seeing margin improvement.
Yes.
Because the legacy orders are ending.
Yes.
So, you know, these are some of the companies where we have a bullish view, and we would like to say that we would like to stay with companies where business models are established, corporate governance is of no question, and see, there is one more thing which is going on in the market, that everything related to crude is going down, so every company will benefit. I think that is a myth.
That is a myth.
Because most of the companies are B2B businesses, where you need to pass on the margin benefits.
Okay.
So we are not bullish on those kind of companies. We are bullish on companies which are in B2C businesses, where they sell to customers directly.
Okay, Parag, we'll have to probe this thought in slight more detail, but you know, it's result season and one management is lined up just as we speak. So I think Mr. Prakash Chhabria, who is Executive Chairman of Finolex Industries, joins us on the show. Remember, extremely good numbers that came in. Mr. Chhabria, good having you. Thanks so much for joining in. I was looking at the results that you've come out with this quarter. It's been a very good show. What's led to this performance? Break it up into why is it that the top line has done what it has done, and how has the operational performance been?
Well, the top line really has not improved. Actually, it's down by 4%.
Which is why I'm asking. But why is it that top line has done what it has done?
Top line is down basically because, you know, we sell in rupees which are converted in dollars. It's a commodity pricing. The commodity, as you know, crude is still slightly going down. So the prices overall have come down as compared to last year's first quarter. Tonnage is flat, but the profitability has gone up, and that is because the raw material prices, which we were expecting would go down, have really crashed, and that is very much helping the balance sheet of the company.
Okay. What about the operational performance, Mr. Chhabria? I believe that is the one. It's been a consistent factor across companies this quarter that operating margins have improved due to commodity benefits or due to tight cost-cutting measures as well. How has it been for you, and how do the quarters ahead look like?
Yes, so we have got a very tight control on raw material, and that's why we get the benefit of that in the bottom line. A, and B, we have also very well controlled our finance cost, and that is also helping us in our profitability.
Do you think that this performance is sustainable? The stock is up 3.5% as we speak. What kind of expansion can you see, you know, on your top line, on the margins, on a sustainable basis?
Our business is very cyclical, and therefore I try avoid giving, you know, future-looking statements only because of that. If you see the quarters, the last 8 quarters, it's always been up and down, and it's expected out of a commodity business. What we do focus on is bringing our debt down, our overall debt. So therefore, if you'll see March on March, year on year, we do bring our debt down. And like I keep saying, we do it without the sale of any assets or without the increase of any equity. So this is all internal generation, which is very strong, which is helping us to bring our overall debt down. What we do in CapEx is grow as per the market demands. So instead of going ahead and spending high money and then waiting for the demand to catch up, we slightly try to follow the demand. And therefore, even though there's a slight delay in our capex, we catch up with the demand, and then we're able to subscribe to it and you know, grow in our business.
Okay.
So I just want to, no, just as a follow-up, it just came to my head, Neil, just a second. On the debt side, what are your plans then? How much debt are you looking to repay? What is the timeline you've laid for the repayment, and what are you targeting in terms of a debt-equity ratio to maintain?
For the last 3 years consecutively, we have been reducing our debt anywhere between 100 to 200 crores every year. And we will keep doing that. And I think in the next 2-3 years, we should be totally debt-free.
Just one final word, Mr. Chhabria. You analysts believe that your net profit for FY16, you may not want to give an exact estimate, but they believe you can clock in somewhere around 185 odd crores. You think that's a reasonable estimate?
If I talk in those numbers, I'm already estimating them. But yes, one thing I can tell you, like I've been always saying, crude prices, when they have a sharp fall, they do have a bad effect on the company, which happened last year. Now crude is easing off, but I don't think crude will, let's say, go from 50 to 25. It's not that expected. So therefore, a slight correction in crude or slight increase in crude pricing will have good effects on the business. So I think this year will be a good year.
Okay. We leave it at that, Mr. Chhabria. Thanks so much for taking the time out, joining us, and all the best for the quarters ahead.
Thank you.
That's Finolex Industries and the executive chairman there, Prakash Chhabria. Just wondering, Parag, I don't know if you've looked at this one at all, but I was reading a couple of notes, not your notes, really somebody else's note as well, and they say that there should be a quantum jump in bottom lines, in return ratios, etc., so on and so forth for Finolex this year and the next. You reckon that can happen? You just heard the management as well.
No. So we don't cover this stock, but I belong to plastic industry, so I know that this business definitely they are in a sweet spot in terms of PVC pipes demand, because once irrigation picks up, apart from the housing, which is right now slowing down, but if irrigation picks up big time in India, in which we are hearing that in some states like Telangana, there are large irrigation projects coming up. So if that happens, I think it is on a secular growth path. So volumes will increase over a period of time. Margins, as he rightly said, will clearly depend on raw material prices. And because
so versus Finolex and some of the other irrigation beneficiaries, would you choose Finolex or would you choose some of the others?
No, so I think they are all in sweet spots. I would like to say that whether it is Supreme Industries or Finolex Industries, I think they are all in a sweet spot, and plus a muted raw material price. See, raw material price has to remain steady. If they decline and remain steady, then definitely they'll benefit in terms of margins also. So on one hand you have volume levers. Of course, not in very short term, because in short term housing is going through some both urban and rural housing is going through some kind of a slowdown. But as the economy picks up, and plus all these irrigation projects picks up, I think they are in a sweet spot.
Okay, fair enough.
What about, okay, so the other set of stocks, and I think we probably have an exclusive story coming up any moments from now. I just saw that vibe of Sandai exclusive as well. By the way, SML Isuzu numbers are out. Not so much. It's a stock that's done really well, I must say, SML Isuzu. The numbers are okay, 23% growth in PAT. We just so used to seeing doubling of PAT or 50-60% growth in PAT, or drop vice versa. That a 23% jump in PAT, which is actually a rather good quarter by general standards, doesn't seem to be too impressive. But since we are talking about commodity prices cool off, I want to speak about the tire names. The way they've run up, substantial. I mean, MRF and with the margins of 20 to 20%, I don't remember in the last 7-8 years that I've seen MRF clock that.
True.
So my question is this a peak? Because this is probably the best that they can clock in terms of EBITDA margins, or do you believe that this is sustainable and therefore these stocks warrant a fresh investment look at?
No, definitely, as managements also keep on guiding that this is not a margin which they feel that they could have achieved and which will sustain.
Right.
Definitely, because
for all of them, MRF, CEAT, all of them.
For all of them, and plus see, in MRF especially, and then CEAT and this TVS Sri Chakra, all these two-wheeler tire companies, they have a limited competition from Chinese imports. Otherwise, truck replacement tires, which is around 70% of the large tire companies' business, they have competition from Chinese imports, and which all of these tire companies have also highlighted. So in my view, definitely margins are close to their peak, but it all depends on raw material prices again. Yeah, raw material prices are still correcting, so you never know that you might have 1 or 2 quarters of better margin still, because raw material prices just continues to correct.
Yeah, the new reality on all these commodity prices is that they stay lower, because there's been a marked shift in dynamics in supply and demand side, and perhaps they could extend out for a couple of more quarters of gains on the operational level for a lot of these companies. But from one tire company to another, and I believe JK Tyres is looking for an acquisition. Yatin has more details on that. Yatin, fill us in. What are you picking from your sources?
Well, after a much awaited deal, Kesoram is finally, selling its tire division, and what we are gathering at this point in time is that JK Tyre is all set to acquire Kesoram's tire division, and the valuation, that bankers close to the deal tell me is close to 2,200 crores at the enterprise value level. So basically, there will be some debt which will be moving out from the books of Kesoram into JK Tyre's books, and possibly they could get some kind of equity consideration as far as the entire deal is concerned. What sources also added as far as Kesoram's tire division sale to JK Tyre is that possibly, most likely, the boards will meet on the weekend, and the deal could be announced as early as next week. So clearly, the much awaited restructuring which Kesoram on record announced that possibly they are looking to restructure the entire business operations. Under this restructuring scheme, the first thing to get restructured or possibly get hived off is the tire division. Of course, when we contacted JK Tyre and Kesoram, they are yet to respond to our email query. We'll possibly wait for their comments. But clearly at this point in time, what we are gathering from sources is that JK Tyre as well as Kesoram are all set to do a deal as far as the tire division is concerned. And currently, if you look at Kesoram, the debt on the books is close to 4,400 crores plus. So clearly the tire division sale will possibly help restructure and consolidate their overall group holding.
Yatin, I don't know if you have these numbers offhand or no. I'm looking at the graphics that we have. The EV value is for the tire unit at 2,200 crores. So any idea about what's the quantum of debt bifurcation that would be there? Just trying to get a sense, if you have those numbers. I know it's a difficult one though.
Well, Neeraj, the plan of Kesoram for this entire restructuring is to get rid of the debt which is there on the books. And what we are getting from our, investment banking sources is that most probably close to 1,500 to 1,600 crores worth of debt would be transferred in this tire division. And the equity valuation given to this deal would be to the tune of 600, 700 crores. So possibly you are looking at a 1,500 crore kind of a debt which will go off the books, and remaining 600-700 crores would be coming in the form of cash or equity as far as the banking sources are concerned. But possibly, more details are awaited. Possibly the boards will meet on the weekend and decide as to how really to break up this particular enterprise value. But clearly at this point in time, this is the information available to us.
Yeah, and it's a difficult one to guess something more than this because it's a moving part. But thanks so much for putting that into perspective, Yatin. The market cap of Kesoram, by the way, is 1,251 crores. Remember, Yatin has been on a story-breaking spree literally this week. And watch out for Kesoram Industries, 1,247 crores of market cap. It's a heavily indebted company, but they are in a piecemeal basis. They are sending out some of the assets that they have in order to reduce the debt as well. Do you track either JK or Kesoram?
No, so we don't track. But I would like to say that whenever any industry is in a sweet spot and with a record margin kind of a thing, it's better if you want to sell the asset then sell at that time. So I would say that it is a timely move by Kesoram.
Right.
That when the industry is going through very good times, they are selling it off.
It's been in the works for a while though, this one. A lot of talk about this. I just think that if the deal goes through with JK Tyre, then maybe, just maybe, the suitors have changed, because a lot of talk earlier about how Kesoram would sell it to MRF. Now we are learning that it might actually go on to JK Tyre, so do watch out for this one. Ashwini, come in on these two stocks. It's the move on Kesoram is probably more an event-based or expectation of an event coming in. I don't know if you can really comment on a trade here, but would you look to trade either a Kesoram or a JK nevertheless?
See, Kesoram has broken out, although it's not a strong stock. But in this rally, we could say, 140, 145. Tire stocks are doing much better than JK Tyres. So probably there are other stocks which could be looked at. JK Tyre overall is not making any kind of new highs. It hasn't really participated in the rally. But if it does begin to rally some more, maybe 162 is the previous high which can get tested. But in these sort of situations, I think you would go with probably Kesoram.
Okay, that's a quick word in. JK Tyres has had a decent run right now and has a decent Kesoram Industries, of course. You can see the impact of that story. They've been wanting to get out of the tire business. 17% up for that stock at 114. That's Kesoram Industries, and their tire business is on sale. What we are given to understand, as per our 18 hour exclusive that Yatin just broke, just for the benefit of our viewers who are joining us, JK Tyres is looking to offer 2,200 crores as enterprise value for Kesoram Industries tire unit, and that's why the stock is up 18%. One can understand at this point in time that Kesoram Industries would want to retire some of their debt with by selling out their tire arm. But come to you, Parag. We've discussed the tire business at length and what's working for the stocks. I also wanted to, from your portfolio and from your research note, talk about HCL Tech and Infosys. Now, Infosys, yes, these numbers were, indicating a turnaround. The new management's leadership is, coming to the forefront quite apparently now. So, that is a given story. And a lot of disbelievers are now turning believers in Infosys, right? So there's that story playing out. But with HCL Tech, there was concern on the margin front this time.
Yes.
And yet you keep it part of your portfolio. And with HCL Tech, there's already been an outperformance. So you can understand that Infosys is doing a bit of a catch up to what HCL Tech and TCS have done in the past. What's the rationale for HCL Tech to still be part of the portfolio?
No, so our point of view is that we want to stay in good quality companies across the sectors, which are generating a lot of cash.
So why don't you have a TCS?
So TCS is also there.
Okay,
Infosys, HCL Tech and TCS. We